Hey everybody, Matt Graham, MBS Live here with you on Tuesday, April 14th, 2020. Bonds are roughly unchanged to slightly stronger now. MBS were weaker earlier in the day. Treasuries were never really weaker. And we were talking earlier about MBS underperforming. We can often witness that simply sitting and watching the dashboard and seeing more friendly movement in treasuries than we see in MBS. It's even easier to see when treasuries are green and MBS are red, which has been the case for most of the day. But there's an official way to do that too. And I'm not just talking about looking at MBS prices versus treasury prices, because as you'll notice in our stack of treasury coupons, it takes more price movement to create yield movement in the longer stuff. So a 30-year bond has to move 6 ticks right now and to not even get to 1 basis point of movement. Whereas a 5-year treasury moves 6 ticks and it's 4 basis points of movement. So quite a big difference there, and it gets more and more pronounced the farther down you go, depending on the coupon level of the bond in question. So higher coupon yields take more price movement to move the yield. So price versus price isn't a perfect measurement when it comes to MBS. We can do visual measurements by some of the charts that I do, which are a little bit crazy and not really scientific, but if we invert MBS prices, then they move the same direction as a yield, and we can see an overlay there. Here's what it looks like in a chart from Refinitiv Icon. I have MBS prices inverted and overlaid against 10-year treasury yields. Yellow line is treasuries, green line is MBS. And this one shows how the middle of 2019 saw treasuries gap out much more aggressively, or gap lower, make improvements much more aggressively than MBS. Because again, green line lower, MBS stronger in this case, because it's inverted. Hopefully that makes sense. But the blue line is the official way. This is the spread between MBS yields, which is something that Thomson Reuters calculates for us, and 10-year treasury yields. The higher the blue line, the more MBS are underperforming. The lower the blue line, the more they're outperforming. So yeah, we've had underperformance over the past few days, and it has looked like this. And gosh, in the bigger picture, that doesn't look too bad at all, right? In fact, it's better than most anything for the past almost 2 years, and leaves us at levels that are better than most anything for the past 2 years. We have to go back quite a ways before we see anything materially better, and that was after QE3 in 2012. That was still the golden age of the Fed's quantitative easing timeframe, and that was the QE announcement that specifically targeted the mortgage market. So being back anywhere remotely close to that, or having to talk about that frame of time as a comparison, or the only other comparison that could be better than where we are right now, means we're in pretty great shape right now. I think the bigger question is, what kind of shape are we going to be in after the Fed continues to pull out of MBS buying? Because it definitely doesn't want to be buying as much as it is right now, and it's only buying as much as it needs to in order to grease the skids of liquidity in MBS. This is something that's been causing a lot of frustration and questions that I've been getting in emails and elsewhere. Why is the Fed only buying however much it's buying and letting MBS underperform against treasuries? Why is the Fed letting MBS fall from 104.5 down to under 104 today? Please take a deep breath and let's try to have some perspective here. Look at the charts, look at where we've been. Pull up an MBS chart on MBS Live, UMBS 2.5 coupons, and let's call it, a 1-month time frame. You are here on April 14th. Okay, you were here back in late March. These huge swings at significantly lower prices. The Fed can't be bothered to give any thought at to concerns about prices moving lower too quickly when today's candlestick looks like this, and even when yesterday's candlestick looks like that. And even that would be a little bit too deeply to be thinking about how deeply the Fed is thinking about MBS. They're thinking in terms of liquidity when the markets can't function because buyers and sellers can't buy and sell what they want to buy and sell. And the only time that we talked about the Fed needing to, or potentially, confirming that the Fed for sure was thinking about MBS prices in a certain range, was when they ran up so high that the Fed really needed to tone it down a little bit and help lenders out by decreasing margin calls and the other costs associated with hedging against volatility, which they arguably did right at the end of March after prices were as high as 105.04, 105 and an eighth on March 30th. then they, arguably got prices to come back down consciously, I would say, and tried to keep them in a range of 103 to 104. And even that was susceptible to a breakout at the end of last week. And now we're moving back into the high 103s and people are freaking out. Not everybody's freaking out. Maybe not even most people are freaking out. But what people are seeing are sharp declines in MBS yesterday and then more weakness this morning and really ugly rate sheets and wondering what the heck is going on. And if we have talked about MBS being decoupled from lender rate sheet pricing, why are we seeing negative reprices in yesterday's case especially? And to that, I would add to my answer from yesterday and pretty much just reiterate it, which is everything's relative. MBS price movement still affects the value of a mortgage on the secondary market. If it moves enough, we can still see reprices. The tolerance for movement was a lot wider when things were more volatile, and we could see quite a bit of weakness without lenders needing to reprice for the worst because they were already priced so poorly and they already had so much of a cushion in their margins, or they just weren't able to take the new business anyway. They also had much bigger movement to worry about on the servicing side. And that continues to be the case for many types of loans or many risk profiles of certain types of loans, especially FHA, VA space. And until that servicing valuation stuff is dialed in, then we will continue to see some inconsistent behavior. And until people have refinanced in the numbers that are able to, like that's a poorly worded sentence, until refinance demand gets as high as it should be, given where rates are, we are still going to see lenders get kind of slammed with new locks and then abruptly raise rates to slow down the pipeline. We can also see lenders run out of funding ability with their warehouse lines, or for other reasons, or even for balance sheet reasons, as Wells Fargo said, the other day with respect to correspondent jumbo stuff. Those can create reprices or straight up announcements of, hey, we're pausing stuff in this sector until we have the money to do it. And that doesn't have anything to do with MBS, but MBS are still going to create reprice risk. If MBS are rising very quickly and a lender already has as many locks as it wants for the day, it's not going to necessarily reprice for the better. It doesn't have any incentive to do that. So those are just the breaks in this market. Lenders are going to be very far apart from one another. They're going to be repricing for different reasons at different times. But they'll all generally be repricing for the worse when prices fall really, really fast or really, really far. And I just want to make sure that's clear when we're talking about disconnection. The disconnection is in a broader sense. It's also at any given moment in time, things are disconnected. And we can revisit this chart real quick, which is the spread between 30-year mortgage rates and that current coupon MBS. So just like this chart is the spread between MBS and Treasury yields, how it spiked really high here. This spike between mortgage rates and MBS has yet to return to earth. And there's no reason for it to do that very quickly until we get a much, much clearer sense of what the forbearance tidal wave looks like and what any mitigation efforts are going to do to reassure investors and to make sure servicers can keep payments flowing. And word on the street, strong whispers, almost a given at this point, is that we will get guidance from Fannie and Freddie on their ability, willingness, game plan when it comes to the saleability of loans that have forbearance on the credit report. More on that when we know it, and we don't know what they're going to say yet, only that something is probable. We also have said or known or guessed from the beginning that we're going to get some sort of relief or assistance or backstop from some combination of the Treasury or Fed with respect to the conventional servicing market. Ginnie Mae has theirs in place. I noticed Ginnie pricing for several lenders I looked at today had improved despite MBS being weaker this morning. And similar things could happen on the conventional side, assuming rates aren't already hugging that low 3% range that generates plenty of refi demand all on its own. Similar things can happen if we get a similar or even better servicing backstop. So much is up in the air, though. I mean, people have no idea exactly how many forbearances we're going to see. It's already bigger than some initial forecasts. And we don't know exactly how it's going to affect a lot of stuff in the mortgage market. We don't know how it's going to affect even prepayment speeds. Some could make the case that it's going to lengthen prepay speeds for borrowers if they're unable to refi out of those loans. Some might say it's going to increase prepay speeds because there's going to be the HARP 3.0 like refi that is going to kill the MBS that those loans are currently in and put them in a new thing. So until those uncertainties are clear, a mortgage investor doesn't have really much of a reason to take any risks of having a low margin in their trading game plan when it comes to the secondary mortgage market. When investors have to leave a wide range of potential valuation outcomes, that means that your clients have to pay higher rates or you have to pay more in upfront costs. It's the way it works. We're paying for uncertainty. Everybody is. Lenders aren't making a killing. You can look at earnings today from Wells and Chase to see that. So nobody's having a lot of fun in the mortgage market right now. And if you're not, that just means you're in good company. I can't do anything to change the frustration. I can just help explain it and let you know it will eventually pass, but it will take time. And I will continue to say this, and I've said this from the beginning, that this whole thing about a servicer backstop is not a magic pill or magic bullet or whatever you want to call it. It's not something that it comes out and suddenly everything's better. It definitely doesn't bring back the riskiest credit box in terms of loan programs or non-QM. And it definitely doesn't mean that this orange line can drop right back down to mortgage rates being 1% over current coupon MBS yields. It means that we can head in that direction, but it will have to be accompanied by actual certainty and track record and observation of how the forbearance crisis, tidal wave, tsunami, avalanche plays out. That simple. We weather the storm until then. We adapt if we need to, and we keep a close eye on how trends are shifting. To that end, keep the community informed, either in chat or if you want to stay anonymous, you can always send me a note in the contact us section. In the new dashboard, which is what I have here on the screen today, it's a little bit different, but in a similar spot. The help menu should be at the top of your screen, and you drop down and hit contact us, and it'll bring you to this link, and that link should look the same. Shoot me an email, let me know confidentially about the lunch you just had with Jerome Powell and Mnuchin and exactly what they said they were going to do for the servicing market or for the mortgage market in general. And then I can pass that on. Or I can just relay it from my own lunch that I have with those guys. Anyway, locking and floating, what do? Well, as you've seen, there are two ways to think about it and two ways to approach it. But as you've seen, rates can deteriorate pretty quickly and not for necessarily any good reason. They can tighten up too, but I wouldn't be looking for that tightening up outside of agency stuff and outside of really vanilla credit boxes. So you can still see hits get bigger or programs go away if you're talking about higher cost things, higher LPA stuff, higher overlay stuff. Overlays can be adjusted up. Minimum credit scores can be adjusted up. Programs can go away. That's going to continue happening. It's going to get worse before it gets better. But if we're just looking at conventional 30-year fixed and even FHA, VA now to some extent, a lot of it's going to depend on the lender. If your lender's really far out of the market, then it makes sense to probably float. But, there's really no guarantee I can give you there because things could still get worse before they get better for some lenders. But we have seen others tightening up quite a bit. And that has been a welcome relief for LOs that have access to those lenders. So there's no 100% right or wrong answer right now. I will say if something is aggressive, if it's in the market, if it's better than other lenders are offering, if your client is stoked about it and you know that you can close that deal, that's a good loan to lock right now. If it's out of the market, if you might get shopped, if a lender is pretty stable in pricing and tends to be more conservative and respond to stuff after other lenders respond to it, and you see other lenders or my daily rate report showing lower rates for that day, and your lender's not there yet, then that's a great situation where it would make sense to wait for your lender to catch up. Hopefully that makes sense. Let me know if it doesn't. Contact us link. Talk to me in chat. Shoot me an email. mgraham@MBS Live. That's going to do it for today. Back with you guys tomorrow. Have a great rest of your day.